Okay. Good evening, everyone. We can start with the class. Today, we're going to look at standard costing. Standard costing. When we are looking at standard costing, the main principle behind standard costing is to be able to. Okay, let me just admit the other guys that we should just know that there's a lot coming now. Okay, in standard costing, this is a very interesting topic. We should just understand that standard costing is all about variance analysis. So in standard costing, what we will be looking at is our budget. We look at the budget and the actual. I think we all do budget. Everyone understands this standard costing. So in our budget, we set figures that we think this is what you are going to spend. But at the end of the day, you might find that the budget and your actual are going to, I think we all experience this in our daily lives. We budget. After the budget, when we have the actual, then we always have a variance. So that's all about standard costing. So which means in standard costing, we are basically looking at the budgeted figures for the organization and the actual figures. Then we see if it is a variance. The reason why a company should have budgeted figures is for them to be able to operate. Remember, they have to operate from the beginning of the financial year before they start preparing their financial statement. So in that regard, then it means they should have budgeted figures. And when determining budgeted figures, we always use our previous actual figures. Even at home, we always use our actual expenses. Like last month, you use this amount for groceries. So that one, you use it as your budget for the following month. The same applies to companies. That's how they does. They use their previous actuals as their budget for the following year. But at the end of the financial year, you'll see that the budgeted figures and the actual are always not the same. So that's what we will be focusing in standard costing to determine the variance. So as a management accountant, when you determine the variance, then you should recommend to management what might be the causes of the variance and what should the organization do in order to correct those variances. That's our role as management accountant in a business. Remember, if you are a management accountant, your role is to advise management. So in that regard, you need to tell them what must be done in order to correct the variances. Sometimes you might find that the variance was as a result of you or this getting an expensive supplier. So in that case, we need to recommend that we should try to find a cheaper supply. Some of the variances are caused by employing highly qualified people who will demand more salary. So in that case, you will see that it's going to cause a variance as per our budget. So that's what we are going to be focusing on. So when you are doing a variance analysis in standard costing, I want you guys to look at the budgeted figure. In your question, look at the budgeted figure and the actual. I think that's basically what we'll be doing throughout in standard costing. What was the organization budgeting to spend, and what did they spend? So what is going to be the variance? Is it a favorable or unfavorable variance? A favorable variance depends on whether you are dealing with a cost variance or an income variance. If it is a cost variance, then it means if you have budgeted less, let's say here you budgeted 10 to use 10 rand, then your actual becomes 12. Then if it is a cost variance, then this 2 rand is going to be unfavorable. But if it is income variance, it's going to be favorable because you were expecting to get 10 rand and you end up getting 12 rand. So when we are doing standard costing, I want you guys to look at the question. The question is it a cost variance or a sales variance? There is a bit difference when it comes to the variances, the adverse and the favorable variance. Because if it is a cost variance, we expect what we budgeted to be, for it to be favorable, we expect what we budgeted to be less than the actual. That is if it is a cost variance. But if it is a sales variance, we expect what we budgeted to be less than the actual. Then it becomes a favorable variance. You will see as we go with the questions how we calculate this variance. So in standard costing is all about reporting variance by comparing actual cost to predetermined standard. Predetermined standards are going to be your budget. So which means your predetermined standards are your budget. So you are going to compare your actual with your budget. Then a standard cost is a carefully predetermined unit cost, which is prepared for each cost unit. So which means at the beginning of the financial year, we must have the figures, the cost that we expect. So which means at the beginning of the year, we must have the budgeted cost for each unit. Then at the end of the year, we are going to have the actual cost for each unit. So these will now give us the variance. The difference between your budgeted cost and your actual cost is going to give you a variance. The standard becomes a target against which performance can be measured, which means that budget, that is the standard, is going to be our target. We are going to set a target, then at the end of the year, we'll compare our target with the actual result. So that's all about standard costing. So which means when you are doing standard costing question, if you are required to answer a standard costing question, the first thing is to look at what are the budgeted figures and what are the actual figures. Then now you can be able to determine the variance from there. So it's easy as all that to do standard costing. Right, then here they say the difference between the standard and the actual is now what you call a variance. So which means in your question, you look at the standard, what was the predetermined rate and what is the actual rate, then the difference is going to be a variance. And in our variance, we have favorable and unfavorable. These are the two types of variance that we have. We have a favorable and unfavorable. So if it is unfavorable, you should now be able to recommend to management what might be the causes of this unfavorable variance. That's basically a management accountant should do in an organization. When it comes to variance analysis, you don't just prepare the figures, then you just say favorable, unfavorable. To management, it doesn't make sense. They need your recommendation. So since we have unfavorable variances, what are the causes and what should be done in order to alleviate those unfavorable variances? So that's basically the role of the management accountant. Remember, as a management accountant, you focus on internal. We don't have financial reporting standards in management accounting. So which means your role is internal. You are there to advise management on matters of the business. So in that regard, everything that you have should have a recommendation. What must be done in order to alleviate that adverse variance, right? Here is still a repeating of what we're saying. Variance are calculated. So in your questions, when you are doing questions, what is the actual price and what is the budgeted cost or price? So you can now determine your variance here. So in the question, whether there is a lot of information, if they ask you about material price variance, so which means you just need to so to look at the actual price and the budgeted price in that material, then it's going to give you the variance. Then we say if sales volume or selling price is below standard, an adverse variance will... Sorry, can you please mute yourself? Who is mute yourself, please? Mute yourself. Can you please mute yourself? Right, so that's there. So if sales volume, what I was saying here is you should look at this when you are doing your question. Am I dealing with a sales volume variance or a cost price, a cost variance? So if sales volume or selling price is below standard, an adverse variance will result. If price or usage is below standard, a favorable variance will result. So these are some of the things that you should look at when you are answering your question. So in standard costing, it's all about actual and budgeted. That's all about standard costing. So you look at the actual and the budget, right? So we have 6 cost variances. This is where I want you guys also to look at. We have cost variances and sales variances. So their adverse is vice versa. We should always take note of that. But let's go through them. Cost variances first. So in the cost variance, we have 6 main variable cost variances. We have the direct material total variance. If you prepare the direct material price variance and the direct material usage variance, and you add them, they should give you this. So which means the direct material total variance is going to be price variance plus usage variance. So if the question requires you to prepare in total, you can prepare the price variance and the usage variance, then you add them together. So that's going to be your direct material total variance. So what are we going to look at when we are dealing with a direct material price variance? So a direct material price variance is all about the price. So which means you are going to look at the actual price and the standard price. That's your direct material. So if a variance requires you to do a price variance, so you are looking at the difference between the actual price and the standard price. Then if a variance requires you to do a usage variance, which means you are looking at the quantity variance. So in this case, it means you are going to look at the actual quantity minus times standard price. So which means here you look at the usage, which means you are looking at the material that was used. So that's basically, so in standard costing, we only have two things that we should look at. One is price, two is quantity. So you will see that in all our standard costing, we're dealing with price and quantity. So what you should look at in the question is, am I dealing with a price variance? If it is a price variance, then you are looking at the difference between the actual price and the standard price. Then if you are dealing with a quantity variance, then you need now to look at the quantity that was budgeted and the quantity that was actually used. So that's all what we'll be doing in standard costing. We'll be doing these two throughout in standard costing. It's price and quantity, which means if the question requires you to do a quantity variance, then you are looking at the difference between the quantities that were used. If the question requires you to do a price variance, then you are looking at the difference between the price, the standard price and the actual price. So throughout our standard costing, we'll be looking at these two, price and quantity. So in your question, these are the things that you should look at. What was the budgeted price and what is the actual price? That's where your variance is going to come from. The same applies even here. When you are doing a direct labor rate variance, it means is per hour, the money that you are going to pay per hour, which is going to be the same like the price per hour. It's going to be the rate per hour. So in the direct labor rate variance, you are just looking at the actual rate minus the standard rate times actual hours that were worked. So it's going to give you a direct labor rate variance. What I want us to focus much on when we are answering question is this part. Am I dealing with quantity variance or price variance? So that you know how to figure out your formula here. Then when we go to efficient variance, then it means efficiency is all about quantity. So this is going to be your quantity variance. So which means here you are going to look at actual hours minus standard hours times standard rate. That's your efficiency variance. So here is where your variance is, because we are dealing with an efficiency, which means it's a quantity variance. You want to see how much of the direct labor was variance was caused by using a different number of hours compared with the standard allowance for. So you want to check here the variance caused by using different number of hours from the budget and the actual. The same applies to the rate. You are checking at how much of the total variance was caused by paying a different rate. Remember, we have a budgeted rate and an actual rate. So you want to...
looked around, found a strange note on the table.
Can you please mute yourself? Who is that? Can you please mute yourself, please?
WhatsApp.
Yay! Can you please mute yourself?
I gotta get out of here. What? Where's my money? On days 57 to 59, I entered the factory form. And there I saw a massive machine that was constantly producing more net.
Can you guys mute yourself, please? Just always remember to mute yourself if you want to talk to other people. Right, so I was here on these two. So what I'm saying about standard costing, this is a very interesting and straightforward chapter. What you need to understand is, am I dealing with a rate? Am I dealing with a quantity variance? Then you know how are you going to form your equation there. The same applies to the variable overhead total variance. So which means here we're looking at expenditure. Expenditure is all about money. So which means we're looking, it's going to be the same as the price here. So you look at what was spent as compared to the budgeted. So that's the variable overhead expenditure variance. So in here, you'll be looking at how much of the variable total variance was caused by paying a different hourly rate of overhead for the hours worked. So you can see we're still using the same thing. So which means here you are looking at what causes this variance to have a different hour rate. So that's basically your expenditure variance. Then you should look at the question if it requires you to do efficient. So efficient, now we're looking at the quantity here. Quantity. So here you are looking at how much of the variable overhead total variance was caused by using a different number of hours. So which means you are looking at the number of hours, actual hours, minus standard hours. So that's what you will be looking at to determine your variance here. So in that case, whenever you are doing your question, efficiency is quantity. What was the budgeted hours and what was the actual hours? So that is going to be your efficiency variance. These are the formulas. I think we have already covered the formula. So which means when you want to do your material price variance, but I don't want you guys to cram the formula. Know how to build your formula, because you cannot cram everything. Know how to build a formula. So how you build a formula is you want to do a price variance. So which means you are going to look at the price, the actual price minus the standard price, because it's a price variance here. Then we multiply by your actual quantity. Then when the question requires you do a material quantity variance, you don't need to cram the formula. You want to do a material quantity variance. So which means you are going to look at the actual quantity, because you are dealing with a material quantity variance minus the standard quantity. times standard rate. So that's basically what you should look at. You should know how to build a formula, not to cram the formula, because if you cram it, sometimes you forget. So what is important is to understand these variances. If it is a price variance, you want to look at the difference between the budgeted price and the actual price. If it is a quantity variance, you want to look at the difference between the actual quantity and the budgeted quantity. That's all about the direct material price variance. The same applies when you build your formula for direct labor. If it is a rate, there is a budgeted rate and the actual rate. So you should now look at those two. What is the budgeted rate? That is going to be your actual rate minus the standard rate times now the actual hours that were worked. So if you understand your variance, there is no need for you to cram, because you look at what am I supposed to do. Here you want to do a direct labor efficiency variance, which means you are looking at the quantity, the hours that were budgeted, and the actual hours. So which means it's going to be actual hours minus standard hours times your standard rate. So that's how you build your formula. There is no need to cram all the formulas. Understand this part. I want to calculate a rate variance, which means we're talking of the rate per hour, which is paid to the laborers. So you are going to look at the actual rate and the standard rate. In your standard costing, you are focusing much on actual and budgeted. So if the question requires you to do a direct labor rate variance, so you in the question, you should look at what was the actual rate and what is the standard rate. If the question requires you to do a direct labor efficiency variance, then it means in the question you look at what were the actual hours used and what were the standard hours that were used. Because we are focusing in standard costing, we're focusing on budget and actual. So which means there is nothing much that should crack your head when you are doing standard costing. Just go to the question and look at the budgeted figures and the actual figures. Then you can get your variance from there. So that's basically what you should look at when you are doing standard costing. The same applies when you are doing the variable over a total variance. You just look at price. You are dealing with price. So what was the actual and the standard? Then when you are doing the quantity, yes.
Evening, Lavmo. I just wanted to ask, is the budgeted and the standard the same thing?
Yes, standard is the budget.
Okay.
Yes.
Okay. I just wanted to clarify that.
If they say standard cost, that's your budget, then your it's more or less the same. So it depends on the question. They might say budgeted figures or standard cost. So in that case, you should know that it's a budget, right? So that's basically there. So I was here on standard costing is one of those you should collect the marks, all the marks in the exam, because there is nothing here. It's all about price and quantity. It's all about price and quantity. So all your variants, if you check that you will be doing, they are talking of the price, the difference between the price and the quantity, and the difference between the quantities. So which means you look at your actual price, if it is a price variant. You look, yes, you can ask Smile.
Yeah, I would like to ask why is it that on price variance we'll say actual price minus the selling price times actual quantity. But on this one, on the quantity, we say times the standard price. First one is actual quantity, but the second one is standard price. How do we come out with that difference?
You are saying in the quantity variance, we use the standard rate, ne? And in the
Yes.
in the price variance, we use the actual quantity. That's your question, right? So
Yeah,
check here. Check here on this one. Let's just go here. Right. Let's just answer while we are using here. So we are looking at the material price variance here, right? So if it is a material price variance, it means we are going to focus on the actual prices minus the standard price, then we multiply by the what? By the actual quantity. But if it is a quantity variance, we are going to remember quantity variance focus on the material that was used. So in the material usage, it means we need now to determine based on what? On the standard price. Because material usage is going to be focusing here on this standard what? Standard price. So which means we are going to look at the standard price when we are determining material usage variance. Because material usage variance focus on the standard price. So it means it's vice versa. When you are dealing with your material price variance, then it means you need now to determine based on actual quantity. Then when it is a material quantity variance, then it means you need to focus on your materials using the standard price of those material. So that's basically how you determine that. Right? I don't know if you still have another question. If there's anyone with another question there. Are we there? I see someone raising a hand. Can you ask Ismail again, or is the previous one? Where is he now? The
Yes,
network.
it's a previous one. I'm trying to lower my hand. I understood what you said.
Okay. So that's basically, so what I want you guys to do, we are going to continue with this topic in our next class. I didn't want us to do everything today. I want to see where we are. So what we are doing today is more or less like a revision of our 2601. So in our next class, I'm going to add some of the few things that we need to know, we should expect to meet in the exam. So as a start today, we're going to look at more or less a revision of our 2601. If you check, if you did your 2601 very well, we did these variances in 2601, right? If there is anyone with a question, I want us to look at this question so that we can demonstrate using a question. These questions that we are using to demonstrate, they are simple for demonstration purposes. We will not have this in the exam. I will ask you guys to do, remember the previous question that we did, there was standard costing. So after the class, I will show you which part you can do on that question. These are just demonstrating questions just to make everyone understand what is happening, so that when you go and apply in a long question, you know what to take and what not to take from the long question, right? Let's look at this activity so that we can demonstrate what we're saying using this activity. the activity says a company manufacture a single product. The standard cost card for 1 unit of the product is given. Okay. So this is so the first thing in your question is who is the standard? So they give us this one as the standard. Then they now go and say for January the company budgeted to produce 550 units, but 530 units were actually produced. So these are the actual, and the cost incurred was as follows. We have direct material. There was 42 kgs used at a cost. Then we have direct labor, all these. Then what are we required to do is to do the following variable cost variances. The direct material price variance, that's the first variance that we need to do. The direct material price variance. Which figures are we going to use? We want to do the direct material price variance. Let me just go to, right, if it is a direct material, so the first one is direct material price variance. So when you are dealing with a price variance, this is a price variance. So which means your formula is going to be what? What is going to be our formula? We are dealing with a price variance here. So it's going to be actual price, am I right?
Actual price minus standard price multiplied by actual quantity.
So the first thing is to do your formula so that you don't get lost. So what we want now is the actual price. Let's go to the question. How do we, we should now be able to get the actual price from the question. Remember, we're doing the direct material price variance. So these are the budgeted figures. And these are the actual. So how do we determine our actual price here? Anyone who has got an idea here? How are we going to determine the actual price here?
I think we need to calculate the cost per unit by dividing the number of kgs into the total cost, so that we get the cost per kg.
Okay, so which means it's going to be 308,484 divided by. So that's how we can get. So what you do in your, when you are answering your question, it means you just come here and say 484 divided by the number of pages, that is 42 845. Then you say minus the standard price. I think standard price we have it. Let's check. What is going to be our standard price per unit? It's how much here? It's 7 kg per unit. Ne? So that is going to be our standard price on the material. So which means we are now going to say minus 7 times the actual quantity. How many quantities were produced? So we look at the actual quantity that was produced here. 530, am I right? So which means we're going to multiply there by 530. That's the actual quantity. Multiply by 530. So let's have the actual price here. What is it going to be? 308.
It's 7 Rand 20 cents.
So which means it's going to be 7 Rand 20 minus 7 times 530. Right. When you are here, you should now look at, is it going to be favorable or unfavorable? Ours is going to be a what? This is the actual and this is the standard. And it's a cost variance. Remember when we started, I said there's a difference when you determine an adverse variance between a cost variance and a sales variance. So in our case here, we budgeted to buy the material at 7 Rand. Now it comes to 7 Rand 20. So it's going to be a what in our, is it going to be favorable or unfavorable?
Unfavorable.
Sorry?
Gonna be unfavorable.
It's unfavorable, ne? Yes. Because it's a cost variance. So it's going to be 0.20 times. If there is someone who don't get the sense of this part, because this is another important part we should to determine whether it's favorable or unfavorable. A cost variance is if our budget is lower than the actual, then it means we spend more than what we're expecting. So it becomes unfavorable in that case, if it is a cost variance. But if it was a sales variance, this one was going to be favorable because we were expecting to use this selling price, but at the end of the year, we have this. So which means it's going to increase our income if it is a sales variance. Then in that case, it's going to be favorable. So there is a vice versa between cost variance and sales variance. So you should always take note of this part when you are dealing with cost variances and sales variances. Right, so what is going to be the last amount there? It's going to be 0.20 times 5. Sorry? You say?
106.
106. Favorable. Is there something that we did wrong? I think there's something wrong here. Which here? Who can pick what is wrong here on this 530? From here, you can when you want to pick, you can look at here. What are these figures for? These are the material costs per unit, am I right? Per kg. So which means here we should not have this 530. Am I right? Because if you look at the question, we just go to the question. The 7 Rand is per kg. And here the production was 42845 kg. Is it not the figure that we are supposed to use? I think we should use this one instead of 530, because if we use 530, we should come here. We are not going to look at 7 Rand per kg. It means we should come here at the total. So in this case, it means if we are dealing with per kg, then it means this is where we are. Direct material is 42,845 kg purchased. So our variance, our actual quantity must be here. Okay, so that's where there is an error there. So it's going to be, let's just correct that error. So which means we're not going to use this one. It won't give us the correct answer. We need to use, because this 7 rand is per kg. So we need to use the number, the actual quantity that was used in kgs. So which means it's going to be, here it's going to be that 42845 42845. So here we're going to multiply by 42845. So what is going to be the correct variance here?
$8,569.
8,569. But do you guys get the sense of what we are correcting here? So you say 8,569. It's not favorable again. Is it favorable?
It's unfavorable.
It's unfavorable. It's unfavorable. So it's unfavorable. So this one is money. You can just put the U if you don't want to write everything. So it's going to be unfavorable like this. So that's how we make errors even during the exam. Because here, if we use 7 rand, it's 7 rand per kg. So which means our quantity must be this kgs. So that's basically how you determine which quantity are you going to use there. Because the 7 rand is per kg. Right? Any question on this part before we look at the other one? Yes, you can ask. You have a question I can hear.
Why is it unfavorable?
Why is it unfavorable? Is there anyone who got it who can answer here? Why is it unfavorable?
It is unfavorable because the actual price is now 7 rand 20, while we had budgeted to use 7 rand. So we have to add a 20 cent on the budgeted amount, which is unfavorable to the business because the expenses increased than what we've been expecting. So it means we have to put more 20 cents per each kg. So to the business, it is unfavorable. It's a disadvantage.
Okay, so what he is saying is 100% correct. When you are dealing with a cost, it's just like you budgeted that at the end of the month, I'm going to use 7 rand. Here the budget is 7 rand. Are we together? The budget is 7 rand. You budgeted to use let's say your monthly transport allowance. You were expecting to use 7 rand for the whole month. But the actual now becomes 7 rand 20. So in your pocket, you have to fork out more money. So it's going to be unfavorable in that case because you are now going to spend more than what you did not budget for. So in that case, it's going to be unfavorable. It becomes favorable if we had budgeted to spend more and then we spent less. Then in that case, it becomes favorable because it's like we save from our budget, we were left with something in our pocket. So in that regard, it becomes favorable. So that's how you determine your favorable and unfavorable. And also take note on this unfavorable. When you are dealing, it's a cost variance, this one. So if it is a cost variance, obvious, we expect to use, we expect to use less than the budget, which is a cost. But if it is a sales variance now, if it becomes more, it means we are going to make more money. So in that case, it's going to be a favorable variance. I don't know if it is clear now. I want you, all of you guys, to understand, because I always see this part is always confusing. When you are dealing with this part, the first thing is, are you dealing with a cost variance? That's the first thing that you need to look at. Is it a cost variance or a sales variance? Because there are differences when it comes to the determination of favorable and unfavorable here. They are different. So let us all understand this part so that we don't make these small mistakes in the exam. I don't know if we get it. If there's anyone else who needs more clarification, then we can clarify, because I want you guys to understand this part. Yes, is there anyone else who has a question on this part? Or are you answered? Are you fine?
No, can I ask a question?
Yes.
When we do the standard costing, is it always going to be per unit, or are we gonna be required to also calculate maybe in total amount given, budgeted and actual, or is it always have to be per unit? That's what I'm trying to understand.
Is it always have to be per unit? Right, that one depends on the question. But in most of our questions, they are requiring us to do per unit. But it depends on the question. Sometimes you may, if it's like if they give you, let me say, like here, well, it depends on the question. They can give you budgeted sales. If you are given budgeted sales in total,
Yes.
and you are now given actual sales in total, you see here, you don't need anything per unit. You just find the difference between these two. You don't mind even about the quantity. You already have the figures. If they give, which is very rare in our third level. In our third level, mostly they want you to calculate this per unit. But here I'm just saying, if you meet a question that give you the budgeted sales in total and the actual sales in total, it means you can get your variance here. By just subtracting your budget sales and the actual sales, you can get your variance here. That is
Okay.
based on that question. But if the
So-
question does, yes.
Because I believe they also given us the total amounts here. In a
You know,
space of, yeah, in the questions. That 567,
let's
isn't
just
it
go
the
to the,
total standard price?
let's just go there. Okay, we are here.
Yes, the 567, isn't it the total amount for that 81 kg multiplied by
5,
70 kg?
okay. This one, they got it after multiplying 81 kg times 7 kg,
Yes. So it's
which
a
is going to
total,
be amount.
yes. And then below there, that 308 isn't it the cost of that 42,845?
That's the cost of this 42,845.
Yeah, so that's why I was asking, is it actually per unit, or do we always do it per unit, or we can actually do it for the total amount as well? I'm a bit confused when it gets there. That's why I wanted to clarify, if is it a must to do it per unit?
No, as long as you are going to come up with the correct answer. If you check in some of the, let me just check something here. Right, let's look at this. This is the total cost of the actual cost. This 308,484.
Yes.
Another way you can do it, let's see if is it going to
Give us
to
the same amount.
yeah, let's see if it is gonna give us. We have this is the actual. So you can say your actual, let's just see, I want to see if it is gonna work. It's going to be 308,484. Then your standard. So on your standard now, if you want to use this, then you're gonna say 567 times. Because remember, this is a direct material per unit. So you are now going to say times the 530. How much are we going to have? I think we should get the same variance.
It's 300,510.
300,000. Here is 300,000.
300,510.
5.
510.
So if we get the difference between these two, I think they should give us that variance that we got. If we minus the 2, 308 minus 300,510.
We getting 7974. So
It's not the same like it's not the same like the one that we got in here. We got how much? Let's just check here, because I was looking at it. It must be the same. Let's check it. Here we got 569, which is unfavorable. So what I was thinking is it doesn't work. It doesn't work. I was thinking if we use that way. But let's check. But it must work. Let's just check again. Because this 567 is for per unit of what was manufactured. Am I right? So that is going to be the standard. And this is going to be the actual. Why is it not coming to the same figure?
not working. No. It's not
Okay,
giving
so
us the same figure.
the same. Okay. So which means it doesn't work. I was thinking maybe we can figure it out that way. Because your question was if we use total, so which means the best is the material per unit. That's the one that we should use for me. We
Okay,
will not be
thank
able to use the totals. So in most of your questions, I think try to focus on the unit price, the difference between the unit prices. I think that one will not confuse much.
Okay, thanks.
Okay. Right. Any other question before we do the direct material usage variance? Right. On the direct material usage variance, let's just go to. So this is going to be number 2. Direct material. usage variance. So here we are looking at what? We are looking at the quantity variance, am I right? We are looking at the quantity variance. So which means we are going to have actual quantity minus standard quantity times what? Times standard rate, am I right? So what is going to be our actual quantity here? Which actual quantity are we going to use here? We are using the direct material. So which actual quantity are we going to use here? Are we not going to check this one?
Is the one.
42845. 42845. That's the actual quantity. So it's going to be 42845 minus what is going to be our standard quantity. Our standard quantity is going to be how much here? Remember, we're not dealing with price here. We want quantity. So our standard quantity is 81 per unit. So which means it's going to be 81 per unit it's going to be 81 per unit times how many actual units, which is 530. Then times the standard rate. What is our standard rate? Our standard rate here is how much here? Where are you guys? What is the standard rate here on material? It's 7 Rand per kg. So this one is going to be the standard rate. So which means we're going to say times 7. So let's work out this one first, which is 81. Remember here we're dealing with material. So each unit produced need 81 kg. So we need 530. So 81 times 530 is going to give us, so it's going to be 42845 minus 42930 times 7 here. So that is going to be our direct material usage variance. So here we want now to look at what is going to happen. Is it going to be favorable or unfavorable? This is our actual quantity, and this is our standard quantity. So is it going to be favorable or unfavorable? Are we there? Are you guys there?
It's going to be favorable.
Why?
Because we used less than what we had budgeted. We used less material than what we had budgeted.
Yes, that's correct. This is what we had budgeted. Then it's 42,930. Then we end up using 42,845. So which means it's going to be favorable. So let's see how much is going to be the favorable. The variance is going to be 42845. From this one, it's going to be how much? Am I right? So how much are we going to have as our 595? Which is favorable. Yes, you can ask.
Can I ask in terms of the standard quantity, ne?
Yes.
Why are we using the actual quantity for us to get the standard quantity?
Right.
Like you've multiplied by 530.
Okay.
Why are we
So
using the actual one?
in your MAC third level, in your 2601, you could see that. So in your third level, when you are doing your quantity, you are going to use the standard material which was supposed to be used against the what? The actual quantity. So in all your cost variances, when you are doing a material or whatsoever labor variance, it means you look at the standard against the actual quantity so that you can determine in this 530 against this standard. So what is going to be the variance based on what was budgeted to be used in this 530 unit? So which means we are going to use standard material per unit against the actual quantity that were produced. So that's how you determine your variance at third level. You are not going to use this figure. I know people were going to check 530. Your answer will be wrong if you take 550. So at third level, you look at the budgeted material per kg against the actual quantity throughout all your third level variances. So that's how you determine the variance for, which means you are looking at these 530 units were supposed to use 81 kg times 530. Then they end up now using 42,845. So that's basically how you treat your standards at third level. So don't make a mistake of coming and use this 550. At third level, it doesn't work. I think even if they might have amended even the 2601. I'm not sure if they amended. But at third level, it doesn't work. You need to use the standard material that was supposed to be used to actual quantity. So that's basically how you treat your cost variances in terms of quantity, which means you are going to look at the actual quantity versus the standard material that was supposed to go into those quantities. Then that's where your variance is going to come from, right? So that's on this one. I don't know if you, so which means always take note of actual here, quantity. But you are using the standard material that was supposed to go into here. So the variance is going to be determined through actual quantities that were produced here. Right? I don't know if you get, but I always take note when you are doing your variance. Go through and look at here. When you do the quantity variance, you don't use the budgeted quantities. You use the actual quantity.
Okay, thank you.
So which means this is something that we should take note when we are doing our variances. Because I've seen it should be in 2601, but I'll check. But I think they have changed it as well in 2601. So that's on that one. Then let's look at here, direct labor rate variance. So you see, it's still more or less the same. Direct labor rate variance. So in our direct labor rate variance, where do we start? We're going to say that's our number 3. Direct labor rate variance. So what you look at here is which variance are you looking at? You are looking at the rate. So what is going to be the formula? Because we are looking at the rate.
Actual rate minus standard rate times the
Actual hours, né?
actual quantity. Yeah.
You can say hours quantity is still correct. Okay. So the next thing that we need now is to go and look at these figures from the question. What is the actual rate from the question? Let's just go to the question. The actual rate, we're here. Direct labor, so this is the standard rate. Mara. Then we're here. So it's going to be here. So how do we determine our actual rate per unit here? Anyone who can come up with how are we going to get the actual rate per unit? Well, these are the number of hours that were worked here.
We divide 400,000 and 764 by 5138.
So which means we are going to divide to get the actual rate per unit. It means we are going to divide by 51,380 here. Then we are going to get per unit. How much is it going to be here? Let's just do it here. 407.64 divided by 51.
It's 7 Rand 80.
So it's going to be 780 the actual. So we can go and fill in our question. So it's going to be the actual rate. You say it's 7 Rand 80 minus the standard. Standard is 8, né? Times how many hours, the actual hours. So it's going to be times 51,380. These are the actual hours. Times 51. Right? Are we going to have a favorable here? Anyone who can determine, is it going to be favorable or unfavorable? Are we there?
It's favorable.
It's favorable.
It's gonna favorable, yes. The rate is 8 Rand, but we spent 7 Rand 80 as our rate.
Yes, it's going to be favorable because we spent less than what we were supposed to spend here. So it's going to be a favorable. That's how you look at it. We spend less. This is the actual. We budgeted to use 8 rand, then we spent 780, which means it's going to be favorable. So how much is going to be the favorable? So here it's going to be 0.20 times 51380. It's going to be how much there?
10,276.
10,276.
10,276.
So that's favorable. You can put a big F there to favorable. So that's how we do. So what I would emphasize on you guys is here and here. Once you know your formula, then it means you can look for the figures in the question. Actual rate, standard rate, is not difficult to look for those figures in the question. And the other part is to determine whether it's favorable or unfavorable. So in that case, know whether you are dealing with a cost variance or a sales variance. You are going to see when we do the sales variance. Right, let's just quickly finish this one so that we can do the sales variance. Right, so the number 4 is it's going to be direct labor efficiency variance. Efficiency variance is just like quantity variance. So which means you are looking at the number of hours against standard hours against actual hours. So in this one, you are going to, what is going to be our formula? Direct labor. So which means we are looking at the quantity variance. So which means we are going to look at what? Actual hours minus standard hours times. All right. So you now go to your question and look for the actual hours. What were the actual hours in the question?
5138.
51,380. So we have our actual hours as 51,380 minus standard hours. What is going to be our standard hours in the question? Standard hours. Where do we go? If you want to get the standard hours,
You multiply 776 multiply no, I think I'm lost.
are we not? Okay.
Times 97.
Yeah, because we want hours. We don't want this money. We want the
Yeah,
hours. So it's 97 hours per unit times the 530. Am I right?
Yes.
Oh, yeah. Yeah.
So that's how you figure out that one. So which means you are going to say 97 hours times. You see that 530. We use always on your cost variances. Use standard against actual here. That's how you determine your variance. So how much is it going to be? So our standard rate here is how much? Let's check on our standard rate.
It's 51,410.
No, I mean the it's 8
Or the
rand.
standard.
It's 8 rand.
8 rand, yes, you're correct. Yeah. This is per hour. Remember, this difference is going to give us in hours. These are hours. So which means we're going to multiply by the rate per
8.
hour. Yes. So how much are we going to have here?
Yeah. Network. Oh gosh, network. Hey.
Ish. Load shedding is killing fish. Times.
Oh, I thought it's from my side. It's a network. I thought it's from my side.
Are we calculating the whole total?
Let's have this one first.
It's 51,410.
It's 51,380 minus 51,410
51,410.
Come on,
times
come on.
times 8. Are we there here? So what when we are here, I want us to look at, is it going to be favorable or unfavorable? That's the point that we should look at here. It was supposed to be here and it is here. Who is bigger here? It's this one. So is it going to
Yes.
be favorable or unfavorable? I think you guys now you can be able.
Favorable.
It's favorable, ne?
Mm.
Yes. So what is the favorable? Let's find the difference here, then we can multiply by 8. So it's going to be 30 times 8 here, which is going to be how much? 240. Are we together on this one? So that's how you do your variance. Just understand the first thing in your variance is here. In all your MAC topics, may I prefer the formula first? What is my formula? Because once I determine the formula, then I know what to look for in the scenario. Because already I have my formula here. I want to calculate the direct labor efficiency variance. How do I figure out my formula? Then this is going to be in formula. Then it's now going to be easy. Even sometimes you get lost. Once you know this part, you won't be lost much. Remember in MAC, they don't come and mark here only. They will mark you from what you have done correct here. Let's say if this variance is good, let's say 5 marks. If somewhere you end up with the wrong answer, but your calculations, if they are showing some of the correct things, you can still even get 3 out of the 5, which means a person can pass MAC without even coming up with the final correct answer, as long as they understand their calculation. Right? I don't know if there's any question before we do the last two. Network is just kicking people out. Yo, I think this load shedding is gonna. So the last two is variable overhead expenditure variance. Variable overhead expenditure variance. Let's look at that one. The variable overhead expenditure variance. Right? What are we going to start? Where do we start? Yeah. We need the variable overhead expenditure variance. The formula. Is it my side? Hello?
Actual overhead minus the standard quantity.
We are dealing with expenditure. Expenditure is just like price.
Okay.
So which means you lost it there. There's something echo somewhere. Right? Anyone else who can come up with that formula? Remember, here, it's just like a price variant.
Is it actual price minus standard price multiplied by actual quantity?
Yes. Just come here and say actual price. Remember, we're dealing with the expenditure, which means you are looking at that expenditure that was done to the product. So it's going to give you actual price of the expenditure minus the standard minus times actual quantity, because it's expenditure variance, which means it's all about the actual price. So you come and look now at your question now. You look at your question here. What we are here. R3 per hour. Variable overhead is R3 per hour. Then the actual is 156709. So we need to determine the actual price for this overhead. What is going to be the actual price for the overhead? Well, these are still hours, which means, so what is going to be the price for the variable overhead per unit?
We divide by the number of hours.
So it's going to divide by 5,380. How much are we going to have here?
80.
Sorry? 156709 divided
290.
by, you get 219. 219.
296.
296. Okay. So what do? We have 296 here. And we compare with here. So which means we are now going to have our 291. So which is 97 times 3 is going to give us 291. This is so which means we are going to have we're going to have you say 296 here against 291. So it's going to be 296 minus 291 times 530. How much are we going to have? The first thing, is it a favorable or unfavorable?
Can I ask, we use 530 or the 51,280?
Sorry?
We use 530 or why we don't use the 51,380 as actual quantity?
Okay. She's asking why are we not using the let's just go to the question. Okay, you want us to use which one? This one. 51380. Remember this 291 is the cost. It's the full cost. This 291 and this 296. So which means we cannot use these hours now, because this is going to be the cost of each unit. This line is going to be the cost of each unit. So which means we are going to multiply by 530, which are the units that were manufactured here. These are the units that were manufactured. We're not going to use the hours. If we wanted to use the hours, then it means we're going to determine the rate per unit and the rate per unit here. But if you check what we have here is here. It's going to be the full cost here. So which means we're now going to look at the standard against this actual units. So that's basically how you, so it's more or less like to come up with, because if you look at this 296 and this 291, these are per unit, which means each unit of this 530 is costing 296 in actual and 291 in budget. So that's basically how you figure out that one.
Can I ask, please?
Yes.
My video did cut me out for a moment. That 296, how did we get it? I'm trying to.
Oh, you were out.
Yes.
This network is just, it's here. We divide 560,709 divided by this number of hours. You got it? You see where it comes from? It's here. That's where the 296 is. Oh, let's go.
I get 3 Rand 0.05 when I divide 156 by 51,380.
Who gave us that answer?
No, I'm saying that's what I get. Now I'm trying to see how you got 296 because
If
I
we
got
divide,
lost for a moment.
if we divide 156,709 over this one, how much are we going to get? You get how much?
3 Rand 5 cents.
Like this?
Yes.
Okay. Someone gave us this figure, so which means that that thing is wrong. I don't know which one is wrong. Let me just try to do it on my side. It's yeah, I never do the calculation.
You know what I did, Love Mo?
Yes.
I'm the one who did that. So in that actual price that we did, so I said 156,709 divided by 580. So that's where I got to 96. I didn't divide
Oh,
it with the 51,380.
okay. Right. But if it's still okay, you didn't divide by 51380, no? Okay.
Yes, I used 530. So that's where I got to 96. So
Okay.
I didn't use the 503.
So which means now if we have 3 Rand 5 cents, that is going to be our actual. Then we compare it with our budget. Right? We compare it with our budget. which means our budget is 3 per hour and our actual is 3. So which means it's going to be like this. Let's try to finish so that we, so which means this one is not gonna be the correct thing. So the actual it's 3 rand 5 cents. It's like this, 5 cents minus 3 rand. How much are we going to have here? How much is going to be this? Is this going to be a favorable or unfavorable here?
It's going to be unfavorable.
Yeah, it's going to be unfavorable. So this one is 5 cents, so it's going to be 0.5 times how many hours worked. Remember, this is per hour, so which means we need our quantity is going to be the actual quantity hours that were worked. Because here we have come up with the hour, so we're going to use the actual quantity of hours that were worked. So it's going to be how much here? 51,380. So we're going to multiply there by 51,380.
0.05.
It's 0.05 here. 0.5 times 51,380. It's going to be how much here?
It's 2,569.
2,569. We say it's adverse, ne? It's going to be unfavorable, right? So
Yes.
yeah, so that's how we will do that one. I think let's go to, I want us to finish, because in our next class we're going to add more on variances. So I want us to finish. Let's go to these sales variances so that you guys, you can see also the difference. Right, when we are dealing now with the sales price variance, we want to reveal the difference in total revenue caused by charging a different selling price from the standard. So which means if it is a sales price variance, it's going to be actual selling price. So it's going to be actual price minus standard price times actual quantity. Right. So what you should look at now is, it's now different from cost variances. In our cost variances here, we were saying if the actual is, let's say the actual is 4 and the standard is 3. In our cost variances, we're saying it's going to be favorable, but here it's not going to be favorable. We're saying it's if the actual, we're saying it's unfavorable. If the actual price is less than the standard, we're saying it's unfavorable. So here now, it's vice versa. This is going to be a favorable. Is it clear to everyone how it become a favorable? Do you guys see why I am saying this is going to be a favorable? It's now vice versa to the cost variance. Anyone who can try to explain why it becomes favorable?
I think it is becoming favorable because now we are talking of sales. So if we had budgeted to sell at 3 rand and then fortunately we managed to sell at 4 rand, so it is at our own advantage. So now
Yeah, so
we're going to get extra 1 rand per unit. So it is favorable.
that's 100% correct. So it becomes favorable. But if it is a cost variance, it becomes unfavorable. So always look at those two. Am I dealing with a sales variance or a cost variance? So that you know how to determine your favorable and unfavorable. So if it is a sales variance, you were expecting to be, it's just like when you get your salary, you were expecting to get this 300. But when you go at the end of the month, they just make an increase, then you get 400. So it's going to be favorable because your income is increased. So always look at, is it a sales variance or a cost variance? A cost, obvious, if the cost that we had budgeted is greater than the actual, then it's going to be favorable in our case because we're supposed to spend more, but we spend less. So that's how you determine your favorable and unfavorable in terms of cost variances and sales variances, right? Then at third level, when we do our quantity variance, we are going to do sales volume contribution variance or gross profit variance. If it is a sales variance, we are no more going to use, when we do the sales volume, we are now going to compare based on the contribution. So which means the sales volume variance is going to be multiplied by the contribution. I think you can see it here on this formula. You are going to multiply by the standard contribution, right? And in sales, these ones, actual quantity, they work, which means you are going to take them as they are. We are not going to do like the cost contribution, the cost variances. You are going to use the real actual quantity when you are dealing with your sales variances. So which means here we'll look at the actual quantity and the standard quantity, then we multiply by the standard contribution. Then the gross profit variance, you use it when you are doing your, if the question is dealing with absorption costing, then the contribution variance, you use it when you are dealing with the direct costing. That's when you determine the contribution variance. But if the question is using the absorption costing, then it means you are going to use the gross profit variance. Remember, in the absorption costing, we are going to have a fixed cost of manufacturing into the cost of the product. But here we don't have, we only have variables. So you look at the question, that's the question, does the company use absorption costing or do they use the direct costing? If they are using the direct costing, it means it's going to be sales volume. But if the question requires you to calculate the sales volume contribution variance from a company that is using the absorption costing, then it means you need to remove the fixed cost element to arrive at the contribution here. It depends on the question. I think we're going to focus on those in our next class. We're going to finish the variances, some of the remaining variances in our next class. So which means when you are dealing with the sales volume variance, it means you need to calculate the standard contribution. After, once you get the difference between the quantities, you need to calculate the standard contribution. But let's quickly look at this small, simple question that is demonstrating that one. They say the following are the budgeted and actual results of a company. Always look at the budget. These are the budget. and these are the actual, right? So what are we required to do? We are required to do the sales price variance. We are required to do the sales price variance, right? The sales price variance. Where do we start? Remember, I told you another thing here that when you are doing the quantity variance on sales, you now have to compare the actual and the budget. Remember, in the cost variance, we don't focus on this actual. We focus on per unit times the actual units that were manufactured. But here you need to focus on your, when you are dealing with the sales price variance. Right. So the question requires us to do a sales price variance. So in our sales price variance, it's going to be, what is the formula? Sales price variance. What are we going to figure out as a formula?
Is this not actual price minus standard price?
Actual price minus standard price times actual quantity. So let me just write it. Right? So let's look at the actual price from our question. What is the standard selling price? It's 59 Rand, am I right? And the actual, it's here. So it's going to be 59 minus 57 times what? 82,400. Am I right? These are the actual. Right. So here, these are the prices, the standard price and the actual price. So the difference is going to be 2 Rand times 82,400. How much are we going to have all in all? $164,800. Am I right? Just multiply by 2 everywhere here. Is it favorable or unfavorable? This is the standard. So I mix them here. This is the standard and this is the actual.
It is favorable.
So this is the
It's
standard.
unfavorable.
This is the standard price and this is the actual price. Is it favorable or unfavorable?
Unfavorable.
Mm.
It's unfavorable.
Unfavorable.
Yeah, it's unfavorable because the standard is higher than the actual. So when you are dealing with the sales variance, then it means you lose some of the income here. You lost 2 Rand per unit here. You lost 2 Rand for every unit. So which means it's going to be unfavorable because you were expecting to get 59. Then you now got 57. So which means you lost 2 Rand. So it's going to be unfavorable. Right? So that's there. Then on the second one, so this one was the sales price variance. You see the sales price variance, the formula is still the same, but what you need to take note now is the adverse and the favorable here when you are dealing with the sales price variance. Yes.
I don't understand there. You said Our formula is actual price minus selling price, ne?
Standard, yes.
So our actual is 59.
Is it our actual?
No, 59 is our
It's me who
standard
made a
price.
mistake. I wrote them by
Yes,
space, so
so 57 is actual price. That's why it's unfavorable.
Page network.
So
you see,
57 is actual price, and then 59 is standard price.
yes. Do you see it now, Smith?
Yeah, now it's clear.
Yeah, it's that's but it's me who made it. The way I wrote it here is what maybe confused you. Because all the formula is no more corresponding now. But the standard price is this one, and this is the actual, which means the standard price is greater than the actual price. So it's going to be unfavorable in this case. Right? Anyone with a question before we do the last one, the sales volume contribution variance. The sales volume contribution variance. That when we are doing the last one there, the sales volume contribution variance. Sales volume right. Remember, we say a third level now. If they talk of a contribution variance, we should calculate that contribution. So the first thing that we need is the formula. It's going to be actual quantity minus times the standard contribution. Right? So we go to our question and look for the actual quantity and standard quantity. Remember, I told you cost variance is the one that you are not gonna focus on actual. You remember what we did in cost variance, but here on sales variance, you need to work out the budget and the actual quantities, the real budgeted and the actual quantities. So it's going to be 82,400 and 81,600. 81,600 is the budget. Then this one is the actual. So which means our actual quantity is 82,400 minus our budget is 81. Times this the standard contribution. When you go to your standard contribution, you come here and look at you calculate the standard contribution. So which means we are here on the budget, standard selling price and standard variable cost. So that is going to be your standard contribution. 59 minus 24 is going to be your standard contribution. So we're going to say times 59 minus 24. So that is going to be, so here, how much are we having here on terms of units? If we subtract 82,400 minus 81,600.
It's 800.
800. Are we having a favorable or unfavorable? Look at here. Is it going to be favorable, this part, or unfavorable?
It's favorable.
Actual is greater than standard, yeah? So it's going to be favorable. So it's going to be 800 times 59 minus 24. It's going to be 35
35.
here. So it's going to make us how much all in all? It's 800 times 35.
28,000.
It's going to be 28,000 favorable. Right. So I was saying here, it depends on the question here. But we're going to look at another question that has got the absorption. So if they are using absorption costing, it means here you are no more going to say standard contribution. You are going to say standard gross profit. That is if the company is using the absorption costing. But if they are using the absorption costing and they say calculate the sales volume contribution, it means in your gross profit here, to get contribution, you need to minus the fixed cost. The fixed cost per unit. Then you will get your standard contribution. But I think there's a question that we are going to look at that will cover that part. Right. Any questions before we close the class? Is there anyone with a question? There's a question that we did last week. Anyone with a question, please always ask. I want us to, I don't know if I still have that question with me. Let me just check a question that we, oh yeah, I got it. Let me share the question. Right, I think we did, on this question, we did A and B. We did A and B. Which one did we say is not covering? So I want you guys to try to do E. Try to calculate this variance from this question. Try to calculate these variances. There's 1, 2, 3, 4. Try to calculate these variances and see where you get lost. So in our next class, we are going to continue with this topic. We'll finish off with this topic in our next class. There are certain things that we are going to add as per our syllabus. So we're going to continue on this topic. But for now, I would ask you guys to try from this question. We did it together. We did A, B, C, D. We did them together. So you can try E and calculate this price. You can see what we're doing. Sales price variance, direct material usage variance, direct labor rate variance, fixed manufacturing overheads expenditure variance. So just try to do the calculations for these variances and see where you get lost. Then we can see from there. But in our next class, we are going to continue with some aspects of variance that we need to know to prepare ourselves for anything that can come in the exam. Unless if there's anyone with a question, if you don't have this question, you can just ask anyone in the group to resend it so that you can do E. Okay, any question before we close the class? Right, if there's no questions, then it means people are fine. Right, so let's go and try to do E. Just try to do it. I always encourage you guys to to practice questions. You will see this is now how the variance will come in the exam. You will now look for the figures from a scenario like this one. So try to get used to that as well. But if you follow what we have been doing, it's not much different because you are just looking at the budgeted figures and the actual figure. Like here, when you are doing your sales variance, you just come here and say the company budgeted to produce, to sell here, and what was the actual sale. Then you look at the actual sale. You look at the actual sale. What was the actual sale? So that's how you determine. When you come to your price variance, you can see here there is selling price. We budgeted at 30 per unit of CC and 35 per unit of WC. Throughout the year, CC units were sold at its budgeted selling price. WC units were, so which means you get your variance for WC in terms of price. You get it from here, 38 against 35. So that's how you, so what, if you know your formula, you'll quickly pick the information from the scenario to use. Right, if there is no question, I'll close the class, then I'll send this recording just a few minutes after the class. Okay, let me just close.